Please read this disclaimer before reading the full article below. Disclaimer: this content from Money Matters Smart MMS channel is for educational and informational purposes only and represents the author's personal opinions. It is not financial, investment, or trading advice, nor a recommendation to buy or sell any asset. Cryptocurrency and stock markets are highly volatile and involve risk. Readers should do their own research and consult a qualified financial professional before making any investment decisions. Any actions taken based on this content are at the reader's own risk. Bitcoin, stocks, and the illusion of direction. Could Bitcoin fall below $80,000? Why markets never move straight, and why whales control the path. When Bitcoin dropped from above $90,000 to the $85,000 area, many retail investors reacted with fear and confusion. Media headlines focused on weakness, uncertainty, and the end of momentum. But for those who understand how markets truly function, this move was not random and not surprising. In modern financial markets, major price movements are rarely accidental. They are shaped by large capital, whales, liquidity requirements, and psychological pressure. Bitcoin is no exception, and neither are stocks. Markets are driven by capital, not emotion. Retail investors trade based on fear, hope, panic, FOMO. Whales and institutions trade based on liquidity, positioning, crowd psychology, time horizon. When an asset shows strong long-term potential, large players do not chase price upward. They need volatility, confusion, and lower prices to build positions efficiently. That is why price almost always moves down before it moves up. Wall Street is no longer ignoring Bitcoin. This is the most important structural change. Bitcoin is now analyzed by institutions, traded through ETFs and derivatives, included in long-term portfolio strategies. Once Wall Street enters, the market changes. Straight-line rallies disappear, volatility increases. Price becomes a tool, not a reflection of belief. Bitcoin is now behaving like stocks during major accumulation phases. Why price goes down before it goes up. This pattern repeats across all markets. 1. Long-term value is recognized. 2. Institutions begin positioning. 3. Price becomes unstable. 4. Price is pushed lower. 5. Retail investors are shaken out. 6. Accumulation happens quietly. 7. The real uptrend comes later. The most uncomfortable phase almost always comes before the biggest move. Bitcoin's decline toward $85,000 fits this structure perfectly. Liquidity is the real objective. Whales cannot buy large positions without sellers. Price declines help to trigger stop losses, force margin liquidations, create panic selling, unlock liquidity. From this perspective, falling prices are not weakness, they are preparation. Why retail feels the market always moves against them. This cycle is extremely common. You hold, price drops. You sell, price goes up. You regret it and buy back, price drops again. This happens in Bitcoin, stocks, ETFs, almost everything. It is not bad luck. It is how markets transfer assets from emotional hands to patient hands. Markets move up and down on purpose to hide direction. If markets move cleanly in one direction, everyone would profit. That never happens. Instead, markets move in deceptive paths. Up, then down, down, then sharply up. Fake breakouts, fake breakdowns. Whales can see where buyers are crowded, where sellers are trapped, where stop losses sit. When too many people are positioned on one side, price moves against that side. This is not conspiracy, it is liquidity optimization. Bitcoin now plays the same game as stocks. Bitcoin is no longer a wild market. Today, institutions dominate structure. Volatility is exploited. Retail provides liquidity. The greater the long-term potential, the more painful the short-term price action tends to be. Policy uncertainty amplifies volatility. Frequent changes in laws, regulations, and economic policy increase uncertainty. When policy direction shifts often, institutions hesitate publicly. Markets become unstable. Volatility increases. But hesitation does not mean disinterest. It usually means quiet positioning. My 30-day outlook. Bitcoin may trade around the $80,000 level based on current market structure, whale accumulation behavior, retail sentiment that has not fully broken. I believe Bitcoin has a high probability of trading around or briefly below the $80,000 level within the next 30 days. Reasons. $80,000 represents a deeper and more meaningful liquidity zone. Markets often push below obvious support to force final capitulation. Whales benefit most when fear peaks, not when confidence remains. A move toward $80,000 would not signal failure. It would signal a more complete accumulation phase. A cautious approach. Why I prefer step-by-step buying. Even though I believe Bitcoin will go much higher in the future, I do not believe this is the time to invest heavily all at once. Knowing the long-term direction does not remove short-term risk. When whales are accumulating, markets can drop further than expected, stay volatile longer than expected, punish aggressive buying. Instead of going all in, I prefer buying small amounts gradually, observing whale behavior, watching how markets and governments react, staying flexible. This approach reduces emotional pressure and helps avoid major losses while remaining positioned for the long term. Belief does not require urgency. Patience is part of the strategy. What I'm watching daily. Price reaction around $80,000. Any sustained reclaim of $90,000. Volume behavior during drops and rebounds. Stock market strength or weakness. Policy and regulatory surprises. Market reactions, not headlines. Final thoughts. Nothing meaningful moves by accident. Not every tick is controlled, but the path price takes is intentional. Markets exist to confuse direction, exhaust emotion, transfer assets from weak hands to strong hands. Those who understand this stop asking, "Why does the market move against me?" They ask, "Who benefits from this move?" That question changes everything. Follow-up article. When BTC trades around or below $80,000. Bitcoin approaches the $80,000 zone. Fear for retail, opportunity for whales. As Bitcoin moves toward the $80,000 level, fear has intensified across the market. Many now question whether the long-term story is broken. But experienced market participants see something very different. They see liquidity. Why the $80,000 area matters. The $80,000 zone represents a major psychological level, a deep liquidity pocket, a point where retail exhaustion often peaks. When price reaches areas like this, it is rarely because the asset has failed. It is because positioning is still in progress. Capitulation is part of accumulation. True accumulation does not occur when investors feel comfortable. It occurs when frustration peaks, confidence collapses, patience runs out. That is when long-term positions are built. What likely comes next? Continued volatility, sharp but short-lived rebounds, quiet accumulation beneath the surface. Markets rarely reward the majority during moments of maximum fear. The smart response is not panic. A move toward or slightly below $80,000 does not invalidate Bitcoin's long-term potential. It reinforces a familiar pattern. Short-term pain, long-term positioning. Step-by-step thinking matters more than prediction. Final thought. Markets fall to prepare, not to destroy. When assets with strong long-term potential experience extreme short-term discomfort, history suggests one thing. The hardest phase usually comes right before the most meaningful opportunity. Thank you for watching the MMS channel. Please share your thoughts in the comments below. Do you believe Bitcoin will drop below the $80,000 level within the next 30 days or not? Your opinion matters. Let's discuss.